Good morning, everyone. Good morning. I'd like to welcome you. My name is Steve McMenamin. I'd like to welcome you, everyone, to the continuing series of the Greenwich Roundtable. Our topic this morning, the most profitable business in the world, monetizing the asset management model, is a continuation of two sessions. The first was held in 1999 on human capital with Nobel laureate Gary Becker, and the second was held in 2007 called Successful Breeding Grounds. It was Ted Seides' topic about cultures that breed excellence. Though no one in this room is quick to speak the words of our title in polite company, our speakers are about to reveal some surprising truths. I'll briefly introduce them after I say this. The speakers' views are their own and don't necessarily represent our views at the roundtable. So having said that, I'd like to start. Patrick Davitt is a founding partner of Autonomous Research, an independent financial services research firm where he specializes in coverage of public asset managers. Before that, he covered broker-dealers, asset managers, and alternative partnerships at Bank of America, Merrill Lynch. Before that, he paid his dues as an investment banking analyst at Merrill Lynch. And sitting next to Patrick is, Erik Weber. And Erik is the CEO of Freeman & Company, a merchant bank and independent advisory firm specializing in financial services. Mr. Weber started Freeman's coverage of private equity and financial technology sectors, as well as completing transactions in a wide range of financial service sectors. Before that, Erik was a strategist and institutional consultant at Schaefer Cullen Capital Management and a vice president at Quanvest Consultants, where he was responsible for screening and monitoring investment managers. Sitting next to Erik is Rich Rosenbaum, and Rich is a partner of Aquiline Capital, a private equity company based in New York. Aquiline is focused on the financial services sector, and Mr. Rosenbaum co-heads the investment management and markets practice. Before that, he was a principal at Securitas Capital, a private equity firm focused on the insurance industry, and before that, he was an associate and analyst in the financial institutions group at Smith Barney and John Hedden Partners, a private equity firm focused on insurance. And the moderator of the roundtable today is Michael Castine, and Michael is a trustee of the roundtable, amongst other things. But what nobody knows until now is that Michael's been guiding our best human capital onto this dais for the better part of 20 years. He's also quietly connected us with the leading policymakers in Washington since we've known him, and you might say he's a connoisseur of human capital. So let's welcome Michael as he frames today's discussion. Michael?
Thank you, Steve. I resemble those remarks. But thank you, panelists, and let's see if we can set the stage here for how we think about monetizing the asset management business model. Some might say you'd put a question mark after the most profitable business in the world. It's funny because the investment management business is why we go to work every day, and why the Greenwich Roundtable has been providing an educational forum on investing for over 25 years. All of us have witnessed the growth of assets under management as well as advisory and the growth of revenue and compensation packages. I love the fact that we're in pollen season. Today, the most profitable business is at an inflection point. And what was a fairly simple business not that long ago of buy low, sell high is changing dramatically. It was not that long ago that $100 million was a lot of money. Clearly, it still is in most of the world. Yet, today, that's not considered real money if you're in the business of asset management and raising money. Even our Greenwich Roundtable used to highlight that we represented billions among its members.
Trillions.
When I was just going to say, and now one firm alone represents trillions, and he's sitting over in the corner over there, 6 trillion that is. And we're all aware of the recent trends. Some are worth highlighting. There was a recent State Street survey that showed asset managers expect to see more competitors merge at a faster pace over the next 5 years as firms seek to compete with cheaper passive funds while at the same time paying more costly regulation. In 2015 and 16, the industry saw the strongest burst of M&A activity in at least a decade as competitors joined forces to manage the structural changes that threaten profit margins. Clearly, companies need to improve distribution and offer a wider range of investments to keep up with investor demand. The reasons are obvious. Active investing is not going away, yet the rise of passive investing is creating structural headwinds for active managers. Fees and assets under management and compensation packages are falling in some cases, and recent M&A within the industry has been motivated by the decline in operating margins. Asset managers have faced a wave of regulatory change since the financial crisis. Just ask our friends in Europe with MiFID II and GDPR around the corner. And the volume of regulations is expected to increase, and that costs a lot of money to meet those regulatory hurdles. And of course, technology. Algorithms, artificial intelligence, and big data are the drivers. If you're not in the know, a robot or a hologram may take your spot. Some even think technology will be making all of those CFA credentials obsolete with the increased focus on fee compression, the fight to passive, index investing, and the new kid on the block chain. Most notable recent trends in private equity include why the firms are getting in business. One report shows a growing private equity influence on both advisory firm consolidation and the growth of financial technology firms, and we'll hear more from Rich on that. Private equity firms are investing about $3.3 billion a year into the financial advisory space alone, with a goal of capturing double-digit returns for relatively short-term commitments. It is sort of ironic that the most prized investment firms have a horizon of eternity, while private equity's long-term view may be 5 to 7 years or less. But the stars seem to be aligning on several fronts, including more advisor firm movement toward the independent space and consolidation of firms. Many of the buyers are looking at firms with $3 billion to $5 billion under management and up, and private equity firms and traditional asset managers are increasingly seeking to buy firms that specialize in alternative asset classes such as infrastructure. It's obvious the fees are higher than in those of traditional stock and bond funds. The private equity firms also see wealth management space as a fertile environment for growth through acquisitions. Then you have the registered investment advisor space is very fragmented, with about 3/4 of the firm managing less than $100 million. But at the same time, it is growing at about 2.5 times the pace of the wirehouses. Just some quick transaction highlights before we turn it over to the panel. In 2017, there were a record 168 transactions involving registered investment advisors. That is up to 22% over 2016, and according to the research, of those 97 transactions and breakaway broker transactions of $1 billion or more, private equity was behind 41 of the 97 deals during the last 2 years. And also the average assets under management of the acquired firm has topped $1 billion for 2 years in a row, according to Echelon Partners. But that list is even second to the 60 private equity firms investing in fintech. In 2017, private equity firms invested a record $16.1 billion into financial technology. That is a number that's up 16% from $13.9 in 2016 and up 475% from $2.8 billion in 2012. So you know the general premise. There's room to use technology and automation to change the value proposition in financial services, and there's many reasons for that. But according to Echelon Partners, their projection for 2018, if the trend level growth rates continue, 196 deals will get transacted in 2018. So with that, let's hear from the experts. Patrick will provide an analytical overview of what he sees in the public markets. Erik is the man to know when it comes to structuring a financial transaction. Sorry for all the other guys that are doing the same thing as Erik who are in the audience. And Rick will give us a view from the private equity landscape. So Patrick, lead us off.
Thank you all for having me. As a sell-side research analyst covering the public asset managers, I'm in the unfortunate position of having a fairly negative view on a number of companies that pay my paycheck. So with that said, there's been this kind of double whammy of increasing regulatory pressure and continued pacification over the last 5 to 10 years that's really evaporated organic growth for the industry, except for a handful that have, scale, top decile performance, and/or passive strategies. So through this lens, I'll talk a little bit about, the valuation decline in the group, and then go through some of, the view on where that can go. Our work suggests that the strongest correlation between valuations in the group is with the firm's ability to generate organic growth. The math suggests a 60 to 70% correlation between organic growth and PE multiples. So we believe this is the key driver of the industry's devaluation, which has essentially been on a straight line since the early 2000s. When you look in, the period between 2000 and 2005, the average asset manager multiple in the market would have been in the high teens. The average asset manager would have been generating 5 to 10% organic growth, and that's collapsed to something in the low teens, in some cases below 10 times now, and an average organic growth rate of right around 0 for the public asset managers. So this leads to the core of my thoughts today. My high-level view of what is causing this and to what degree the trend is secular versus cyclical, which is probably the most common debate I have with my clients, generally long-only managers and hedge funds. Unfortunately, the message still feels pretty dire. We've identified 4 to 5 broad trends that all suggest the trend is still firmly entrenched for the foreseeable future, and they're all interconnected and play off each other in certain ways. First, active equity performance is not back. There's a narrative in the market now that it is, but the math that we have suggests that only roughly half of the funds are outperforming their benchmarks. We don't think this is good enough to really shift the dynamic back to active flows. That's actually worse than last year, so it's interesting to me that the press has gone down this road of saying it's better when it's worse from what we can tell. So it's hard to see the pendulum swinging back to active as long as that's the case. Second, the traditional distribution pipes have really broken down for these firms. Pay to play is over. You can't pay a platform to put your funds on there. Commissions are going away despite the DOL rule going away. Captive brokerage forces increasingly have to sell third-party product instead of captive product, if they even exist anymore. I think that's a dinosaur of a business unless you're an insurance company. And then you have technology and robo-advisors, things of that nature that are taking share. They're bringing new investors into the fold, but only into very, very low-cost products like core ETFs. And this all leads to consolidation of relationships, consolidation of AUM with the largest firms, and lower fees. And you're just starting to see some of this hit Europe as well. The pensions are being forced to consolidate in the UK. And even regulatory shifts on the continent, which has traditionally had very, very high moats, or very high walls around their distribution, are starting to break down. Third is regulatory. Mike touched on this, but it remains very, very high. I think in the US, kind of post-Trump, there's a view that the regulatory pressure has gone away. There was never really that much. It was just starting, so it's just kind of stopped. And I think because the DOL rule was in effect for so long, a lot of firms have already gone so far down the road of adoption that they can't really go back. And then in Europe, the regulators are going full steam ahead. If you think about the period post-crisis, the regulators were very, very focused on the banks and the broker-dealers, and that eye has kind of turned to the asset managers, which is never a great position to be in. So you have a list of alphabet soup of agencies in the continent and in the UK, basically telling asset managers that they make too much money. You've got the FCA competition review in the UK, the CMA review of the pension consultants in the UK. The ESMA on the continent is just starting to go along the same route as the FCA in the UK, so they're about 2 years behind there. So you just have this long list of things that all suggest fee pressure, more pacification, more consolidation to the largest players, a lot of what we've seen in the US. Finally, we have a view that fee pressure is really just starting. The press has created this narrative that fees have come down significantly already, but it's really the weighted average fee rate. Advertised active equity mutual fund fee rates really haven't come down that much. And you're just starting to see, at least the public managers I cover, talk about having to do fee rationalizations, using some of the savings from tax reform to cut fees. And Even in the introduction of fulcrum fees, AllianceBernstein in the US is quite famous for doing this, which is basically a performance fee model, which could be great for the industry, could help stem the outflow issues, but it's terrible for the public market multiples. The market just simply won't pay as much for a performance fee as they will for a management fee. So all that leads into the last trend that's still firmly in place, in our opinion, is pacification and increased ETF adoption. All of the things I just talked about kind of feed that beast. And the market, in that vein, the market is simply not as passive as the press says it is. The press quotes a lot of 40 to 50% of the industry is passive now. Those are mutual fund numbers. If you think about all the other participants, if you think about institutional accounts, hedge funds, which probably create multiples of their AUM in terms of price discovery in the market, private equity firms, the actual percent of the market that's passive is probably closer to 20%. So we still have a long way to go, I think, before that pendulum swings back, that the market is too passive to work. And with that said, year to date, the flows are still largely passive. Equity flows year to date are 150% passive. Bond flows year to date are 75% passive, which is up from 43% last year. So that's a little bit more discouraging because the bond market has generally been less exposed to this trend. On those last 2 points, I would reinforce that Europe is probably 5 or more years behind the US on all of these issues. And the regulatory kind of pressure that we're seeing there is probably going to force the issue, unfortunately. So to finish, I have some silver linings. It's a pretty negative view, unless you're BlackRock. So in that vein, the battle for kind of traditional passive dominance has been won by the BlackRocks, the Vanguards. I don't think anybody can really make inroads there at this point. But there are players making inroads in non-traditional beta projects. Smart beta, I don't like the term smart beta, but it's out there. If you're first to market with something, you can generally get a lot of traction and grow those. Obviously, alternatives are still immensely popular. Traditional asset managers want to be in alternatives. They're introducing a lot of products that are alternative light. Obviously, the large alternative managers I cover, the KKRs and Blackstones, are just sucking in assets left and right as sovereign wealth funds increase their allocations. High net worth people are increasing their allocations. The pension funds are consolidating their relationships with the largest players. Asia, I think, is a huge opportunity for the traditional asset managers. Fees are very high. Feels like it's opening up. Unless we have a trade war, we'll see if that continues, but it does feel like it's opening up right now. And then technification can be an offset to a lot of this stuff. Yes, it creates some headwinds, but I think a lot of the stuff from the blockchain side and AI and whatnot can cut a lot of expense out to help offset the revenue headwinds I've discussed. So to sum it all up and tie it back to my opening statements, I think all of this suggests the devaluation I talked about at the beginning is largely deserved. There are very few companies in the group that deserve a premium multiple, and the ones that do, the BlackRocks, the T. Rowe's, the Eaton Vance, are getting it. So all these drivers are still very much intact and in some cases accelerating. So it's tough to see the pendulum swinging back anytime soon.
Thank you, Patrick. One thing, do you have a prediction of when it might swing back for the investors here? And when would you say that, or if you picked one investment, what would it be if you're advising this group?
Okay. Yeah, I get that question a lot. Unfortunately, I think at this point in the cycle, the only thing that could really kind of prove the worth of active and swing the pendulum back would be a big correction. Theoretically, given the amount of money that's come into passive, I would expect a negative feedback loop when that money comes out and the market's going down, that active managers theoretically should outperform. If they don't, Lord help us. Theoretically, I think that's what it would take for people to be like, oh, wow, maybe I shouldn't have been all in this S&P 500 core ETF and been in this active fund that was 30 basis points more because it outperformed by 200 basis points when the market tanked. But until that happens, it's hard to see it really moving. And obviously, you don't want to own an asset manager into that because the earnings go down significantly with the mark to market. If I had to recommend one product to be in now, I think, it's tough given where valuations are. So I think, a lot of these capital preservation plus alpha vehicles that have come out for lower fees than hedge funds would probably be places I would go. I'm trying to think of a good example. AQR has some of them. There's GTR at Invesco. But things that, have a lot of downside protection.
Great, thank you. Excuse me, I got to call my broker. Erik Weber?
Yeah, so I focus my time doing M&A in financial institutions, mostly asset managers. I think, look, Patrick's spot on. Jack Bogle and Larry Fink are causing huge problems in the industry that are not going away. From an M&A perspective, I'll touch on some views of the public companies because we interact with them, we sell them things, and if you're either considering which ones to buy or interact with, maybe that's helpful. I'll comment on a lot of these minority stake buyer funds that have popped up. You may be pitched to invest in it or to create one of your own. I largely view those as yield cos, and I'll elaborate on that. I think that moves into a little bit of the seeding and acceleration as a large institutional allocator. You may have done some of that. You may be considering that. Some notes on what I've seen work well and what hasn't, and then obviously the M&A market and what's going on there. Perhaps to start at it, when we meet with asset management executives, whether in the big public companies or owners of private firms, and they ask what's going on, the pieces that I raise, which no one yet has told me I'm wrong, is number one, there's a fee and a flow problem for most people. There's rising compliance and regulatory costs. There are the increased costs of distribution, although in most cases, salespeople are actually making less than they made 5 years ago. The platform costs, the due diligence costs, the cybersecurity costs of being on Morgan Stanley's platform or any other channel, the length of due diligence, the scrutiny that it takes, distribution costs are up materially. So all of those things put pressure on margins, and the answer is often size and scale or other cost attributes. If the industry didn't need a wake-up sign, I think AllianceBernstein moving its global headquarters to Nashville should send a big warning shot to people on what is going to happen to this industry. Now, if I go through like active, passive, and alts, deal with the public companies before moving on to the private markets, when I first started in this industry, very regularly saw the Eaton Vances and Federateds trade at 14 times EBITDA, maybe 15 times, but that was a very normal number based on the data that Patrick indicated 15, 20 years ago. And today you're regularly seeing EBITDA numbers like 8.5 to 10.5. I mean, it's a remarkable shift. They're different in the alternatives. When you look at those, not only have unusual structures, but they have defensible fees. Their products cannot be originated or developed by most institutional investors. And we get asked the question a lot about, alternatives, all the trends in alternatives. I go back to the mathematical question that the pension system here was largely built around 8% return assumptions. I first worked in the 401k industry, and some of my first accounts had GICs, which no one under age 40 knows what the hell a GIC is. It's very hard to explain to a millennial, but I remember Hartford GICs and like accounts I serviced at 8 or 9%. I mean, who wouldn't mind a single A plus or double A minus 9% return today? That's come down to 7.5, maybe 7.25. But the old 60-40 math of stock bond portfolio and go play golf doesn't work at the rates we've been having. Now LIBOR's come up 100 basis points, but from a mathematical perspective on where yields are, that is why you've seen a tremendous boom in alternatives. It's why the yield-oriented managers of Ares and Guggenheim, Apollo, and Oaktree have been booming to the degree that they have. And every single survey you see, Greenwich Associates, you name it, right? Every chart on alternative allocations looks like this. Sorry, Rich. Every single one. And that'll stop. They'll hit market saturation. But I think the alternative firms have flows in their favor, the fees are defensible, and it's very hard to disintermediate them because of the human capital component that puts together term sheets and actually does due diligence. Now, if you were thinking about the passive side, there's BlackRock, there's Wisdom Tree, which I call a smart beta play. And then actually you can look at proxies like S&P Global. While they have their ratings business and their data business, 40 some odd % comes from index licensing. BlackRock trades at a pretty high, I think 15 and a half times EBITDA when it's cheaper. I actually bought some and I just tucked it away for the like literally my kid's retirement account in 50 years. The index industry looks very much like other oligopolistic financial service businesses. If you look at the fund administration businesses, if you look at the custody businesses, they all end up with a pyramid with 3 people who control upwards of 70% of the market. You end up with about 7 mid-market players. In custody or fund admin, that would be people like U.S. Bank. In indexing, it's going to be players like Wisdom Tree or Direction or Van Eck or someone like that. And then there's a bunch of small guys down at the bottom which don't matter anymore. Don't invest in some small startup ETF. The cost of distribution and market saturation of product, I don't care how brilliant the idea is, I think it's a losing proposition. The minority stake buyers, I think, have become really interesting. What are the needs of most of these middle market players? You may be investing in them. You may be pitched to invest in Dial or the Peters Hill Fund or the Blackstone Fund. There's about 10 others trying to raise funds, including Carlyle. Most of these mid-market firms have a need for size and scale, but they also have some very normal needs. They have ownership succession. There might have been a family, there might have been an insurance company who seeded them or staked them, and they've just outgrown that relationship for some reason. Times have changed. The patriarch at the family or the backer at the insurance company or pension fund has moved on. They don't have an active supporter. And frankly, the needs of the business have changed. What are those needs generally? It's always equity recycling, right? No one lives forever. They always have a need to get equity in the hands of the next generation, recycle their equity. Number 2, asset managers have tons of ideas, right? So seeding an anchor tenant, someone they can go to help get a product up off the ground is very, very, very valuable. They usually don't want someone to interfere in their products. And lastly, they have a great need for distribution. A seeder or a stake buyer isn't necessarily going to do that, although the Dials and Peters Hill and Blackstone are doing much more to do that. Pricing is, where they're buying, usually around, 9 times EBITDA, but sometimes they're going up over 10 times. Let's just use 10 as a number. If you're a family or someone else in one of these vehicles, that's going to just give you a 10% cash-on-cash yield. There's almost no CapEx in these businesses, as you know. And so putting together a diversified pool, perhaps with some leverage on a baseline 10% yield, with hopefully firms that they've picked and chosen mostly in alternatives that have both fee and flow trends in their favor, may be worthwhile pursuing into these yield co stake buyers, or perhaps pursuing on your own. Consider it kind of a seeding or acceleration deal on your own. I think while you may primarily be an asset allocator of your own money or your client's money, and so the product they make is infinitely important, I think the best money manager is put together when 3 people found it, and one's the product whiz, one makes the ships run on time, ships and trains run on time, the COO, CFO, and someone's awesome at distribution. I think distribution is a real skill set that sometimes gets undervalued, particularly in private firms. They are usually founded by the the stock or bond picker, the genius who values things. In the absence of, a real distribution whiz, I think you're just leaving a lot of money on the table, and I've seen it time and time again. Lastly, the M&A market. A lot of the public companies, if you look at Victory, Eaton Vance, Virtus, a number of them, they're way overexposed in active equity. So I expect, and we chat with them, I expect they're going to continue to look at how do I get greater exposure into fee defensible and positive flow asset classes. Old Mutual, which is now BrightSphere, bought Landmark, which is big private markets. I would expect that to continue with all the players. And then they're going to have to do things on rationalization, on compensation, costs, operating margins. And frankly, a lot of middle market sellers in traditional asset classes are going to be forced into consolidation deals. Because I think as humans, they have certain price expectations. They may have certain fiduciary duties to maximize price. And to get the price that they want, or they feel as fiduciaries, they're going to have to force something into AllianceBernstein or some other consolidator, because to make the math work, given the data that Patrick pointed out, you have to put the cost cuts on the table in ways that the industry wasn't willing to consider before. I've done deals with 3 people sitting around this table. I think, cost cuts, we have seen strategic buyers have a consistent ability to outbid a private equity sponsor by 20 and upwards to 30% by factoring in the cost takeouts that they can put on the table. COOs are very expensive, CFOs are very expensive, general counsels are very expensive. You can put those 3 people together and get $5-6 million in cost takeouts in a private company that might only be making $20 million in EBIT. That's a material pricing difference that a public company could do versus what Rich and his private equity group might be able to underwrite to. So with that, I'll stop. And
Great. Thank you, Erik. Can you talk about, a lot of your work over the years has been with traditional and alternative firms, and now we're seeing a lot more activity in wealth and fintech. And are you seeing a shift in the acquisition of those firms? How would you put a percentage on it? Okay,
I've
thank
seen
you.
20 wealth management roll-ups. Man, they're just, people are people. I mean, go figure that equation out. It's really freaking hard. Yeah, look, fintech goes to a lot of Patrick's comments, and I think Rich. It's like, hey, let's take a basic money manager. They're probably running 40 to 50% comp to revenue, sometimes higher, sometimes lower. They're likely spending 15 to 30% on operating costs, and then they're delivering in the public companies maybe 30 to 40% EBITDA margins. Those are the only 3 levers. They're going to do everything they can, like AllianceBernstein, on moving to Nashville. Like, what are my non-comp? I think over time you're going to see shifts in compensation. I mean, it has to, and margins may come down. I think people will fight it with, as Patrick and I commented on, like, there's this race in size to scale because your incremental margins are so tremendous that there's going to be this kind of fight to get bigger and bigger and bigger to try and preserve both compensation and EBITDA margins. And so I think people will attack the cost side first. And fintech helps do that, because if you can tackle labor costs, which is a huge piece, and customer acquisition costs in your sales in any way, shape, or form, or make your back and middle office more efficient, those are all winning things that people are going to continue to invest in.
Great, thank you. Rich?
Thank you. So I guess I'd start by saying, Michael, I certainly hope you didn't have me going last, thinking I might be able to allow us to finish up on a more positive note as it relates to
We're going to be
industry.
giving out tissues at the end of the show here to
Than Patrick and Erik.
dab your tears.
when you invited me to speak at this panel, and I saw the topic of the most profitable business in the world, I've got to say, for a while I was trying to figure out why I was invited, since I'm not really that big of a...
We couldn't get anybody else, Rich, I'm sorry.
Not really that big of a fan of investing in the asset managers, but I guess I will say a few words, maybe speaking to why I feel that way, and why maybe at Aquiline I'd say we have treaded very cautiously anytime we've thought about more traditional asset management type investments. Spend a little time then talking about when I forget that I don't like investing in asset managers, and actually spend time looking at one, at least what are some of the key considerations we think about when it comes to investing in these businesses. And then maybe finally finish by speaking to, if not asset managers, how are we thinking about putting money to work in the broader ecosystem? Because it's all great for me as the head of our asset and wealth management practice to not put money in asset managers, and that may very well be the smart thing to do, but ultimately our LPs are paying us to find ways to intelligently put money to work and generate returns. Actually, I guess what I'd really start is to the comment about the most profitable business in the world, and what has attracted people to this space, is there are a few pretty compelling macro considerations. One is when it comes to an addressable market, the market size, and the structural demand that exists on a global basis for asset management products and services. There's probably no better industry in the world. I mean, it's really quite extraordinary. I think some of the statistics, I think last year there might have been global flows of $2 trillion worth of capital into the asset management industry. I think over the last 10 years, it's a number that might have been, I'm tempted to say, closer to $12-13 trillion total. And look, my numbers might be off a little bit, but it doesn't change the fact that there's just an extraordinary amount of capital that just continues to get generated on a global basis, and that capital's got to find a home. It's got to find a place to be invested. The other key consideration is when it's going well, it really is a great business model. You're getting paid on assets under management. What other industry exists where, on January 1st, you're basically starting the year exactly where you finished the prior year on December 31st, right? The assets are making money for you 24/7, and these are highly scalable businesses. You benefit from the market growth. You don't necessarily need to keep adding more people, so certainly when things are good, these are very attractive, scalable business models. But what are the risks, and why have we been pretty cautious? Look, my sort of fellow panelists spoke to some of these. One, the whole issue of the pacification of the industry. That's a permanent secular trend that's not going to make it any easier for the traditional asset managers. They spoke to fee and margin compression. No reason to think that's going to change. Spoke to the increasing role of technology, and I think it's pretty interesting. It was a few months ago, I think it was BlackRock that came out with some comments about using AI, and that's going to start to replace some portfolio managers. And that's great if you're a BlackRock and you've got the size and scale and the ability to do that. That's not so great if you're a $10-20 billion manager. You probably don't have the same capabilities. I'd say more specifically from a private equity perspective, as Michael said, we go into our investments with a 5 to 7 year time horizon, and can joke about that being a relatively short period. It certainly seems, I think that would be an eternity for the hedge fund community and your clients, Patrick. But in the context of a 5 to 7 year period for any investment we make, I'm going into that on the assumption at least something's going to go wrong along the way. And if I'm lucky, it's only going to be one thing that goes wrong along the way. So we spend a lot of time thinking about what could go wrong, what are the risks, and what are the proverbial tools in the toolkit we have available to help us address those risks or potentially mitigate those risks. And the problem is when you're talking about an asset management business, your single biggest risk is the market. And we think we're pretty good at what we do at Aquiline, but we still haven't yet quite figured out how to influence the market. And so, your single biggest risk is just uncontrollable from our perspective. I'd say another somewhat related consideration is the topic of performance, and I think, Patrick, you specifically talked about this. And again, there's been a lot of different sources, different studies that have looked at the issue of performance. I think there's general consensus that at least over time, you probably have less than 50% of active managers that are outperforming their benchmarks. And again, I certainly don't think I'm smart enough to try and consistently figure out, even if it's 50-50, consistently figure out which half are going to get it right and which half aren't going to get it right. And the other thing is when they do get it wrong, or eventually you get something goes bump in the night that throws off the performance track record, right? The old adage is it takes 3 years to develop a 3-year track record, and again, when you start to think about that, for us in the context of a 5-year hold, if something goes wrong, and the best case scenario is you can turn that track record around over the course of 3 years, it's not leaving a lot of room for margin. And again, we also don't feel we can do a lot to help influence the track record. You're really relying on the individuals running these businesses, which brings me to the final point from our perspective, which is, many times these businesses have real key person risk. You only have to, look at what, even one of the largest asset managers in the world, PIMCO, went through, with Bill Gross's, departure, and that's not even getting into, leaving dead animals in the vents at his home. Among other things, because you had to turn the house over to your ex-wife. So you become very dependent on some key people, and that can just be really challenging, especially because even if you thought you bought control of a business, you find out that you really don't have control, and that key person or key people are really the ones who ultimately have control. So I guess all of that having been said, when I kind of do forget all of those considerations and have from time to time looked at some of these businesses, and oftentimes working with with Erik, what are the things we do look for, or at least take into consideration? In no particular order, we certainly think a lot about specialization, what maybe makes this manager differentiated. It could be something in the product side, it could be something related to distribution, but really trying to think about a business that has some specialization or some differentiation. One of our earlier investments, which we've long since exited, was a business, Conning Capital. They specialized in serving only the insurance industry. To be fair, I'd say their investment product was almost somewhat commoditized. It was predominantly core fixed income. But when you're serving the insurance industry, you've got a lot of unique reporting requirements. You're really managing money on a constrained basis. There's a lot of unique regulatory and accounting considerations. And, we felt that created a bit of a moat around that business, and that would create some scarcity value ultimately for that company, as maybe other asset managers were looking for ways to get into and access the insurance industry. We think a lot about ownership. Oftentimes, to a point I made earlier, our view is you probably don't want to own 100% of a lot of these businesses. Again, because even if you own control, you don't have control, and therefore, why pay for it? And it's an alignment issue as well. If I've got a business that's dependent on some key people, I want to make sure that they've got skin in the game, that we've got real alignment, And I'm probably really happy if I only own 30% of the business and they own 70%. I feel pretty good about the fact that they're going to be doing what's right for the business and growing the value of that business. Certainly would want to think about the ability of managers to generate alpha. This gets a little bit, maybe somewhat the flip side of the comment I made earlier on sort of what makes it special or differentiated. So whether that's their ability to generate alpha or some uncorrelated returns. And that's actually where we see a lot of interesting activity in the market today and the emergence of some kind of unique and esoteric asset classes. Litigation finance is actually where we've actually put some money to work recently. If you think about the insurance industry and insurance-linked securities, and that's a fairly uncorrelated stream of returns. Since last I checked, Mother Nature isn't really paying attention to what the rest of the market's doing. If you're talking about taking on some type of cat risk in asset management form. We think very much about the ability to add value to the business in which you're investing, because our view is if you can't help the business in some way, then ultimately, and probably sooner rather than later, the people running the business are going to view you as a tax on their own earnings, and that's probably not a great place to get to with the human capital on which you're dependent. And I think the final comment I'd make is, we also think a lot about use of proceeds, and this touched a bit upon some of Erik's comments, especially with what's going on in my industry, where you've got the firms like Dial that are buying stakes in managers, and we think about that anytime we're looking at an asset management business. We're very mindful of what's the use of proceeds. If it's just a bunch of people, key people that want to cash out, we've got to ask ourselves, why are we so lucky to be getting involved here? But if it is to help facilitate generational transition, if it's capital to help act as a catalyst or fund a consolidation strategy, or really maybe help develop some new distribution channels, that could be a bit more interesting for us. All of that having been said, what is interesting to us and where are we spending our time, and I'll try and move through this somewhat quickly. We've liked the wealth management space a lot. We think there's a lot of great macro trends there. Again, a lot of these were touched on. The move towards independence. You've got obviously the growing end of the RIA industry. We think we're still very much in the early innings there. And ultimately, we don't believe, notwithstanding all the money and attention that the robos have attracted, I'm certainly not expecting in the foreseeable future that people aren't going to still want some human element and the ability to speak to a human being when it comes to their life savings, their ability to plan for retirement and pay for the important things in life, a wedding, their kids' college education, making sure they've got enough to cover their own healthcare costs later on in life. People want to speak to a human being. We talk a lot at Aquiline. We like to invest in pick and shovel businesses. And we certainly didn't invent that term, and it's really just a reference to the old gold mining days, which is, do you want to be making a bet on which miner is going to strike gold, or do you want to be the guy selling picks and shovels to all the miners, and somewhat indifferent to which one of them is going to strike gold? And so, that's broadly a lens of how we try and think about ways to play the broader asset and wealth management industry, given some of the very attractive macro trends that I referenced at the very beginning. Again, I'll just use it as an example. We had a prior portfolio company that was basically, it was an asset management platform supporting independent financial advisors that were essentially leaving the wirehouses, joining the independent broker-dealers, and this was a business that they would join, they might join an LPL, they would do their brokerage business through an LPL, they would look to this company, though, to do their fee-based business. And so we thought that was a really interesting way to sort of play those big trends on a somewhat derivative basis. We spend a lot of time looking at technology businesses, technology-enabled service providers, for very much the reasons that Patrick and Erik spoke to. We have been interested in differentiated asset classes. I referenced we've been doing some work in investing around litigation finance, and we do think there are some of these really interesting emerging asset classes that we think should continue to attract flows. And I think the final area we think about, among many, again, Patrick, Erik talked a lot about regulation and compliance, and that's creating increased needs on the industry. With those increased needs come increased costs. And so, not surprisingly, we're also seeing a real proliferation among service providers and technology-enabled solutions, targeting ways to help the industry deal with increasing regulation and increasing compliance requirements. And so we've spent a lot of time looking at and pursuing opportunities there as well.
That's great. Thank you, Rich. As you look at these firms that you're buying, and part of it's a percentage of, say, 30% ownership versus 70% for the team, how do you get comfortable with the team being able to produce to the levels that you want in that time period?
Again, if we're talking about an asset management business, that's the challenge. And so I think what we look at there, or certainly one of the things we think about is, what has this team or what has this firm actually been selling to the marketplace? If they've been selling performance, if they've been the proverbial hot dot, they've had a really great 3 or 4 year run of it, that's going to be a lot less interesting to us, because I can't get comfortable that for the next 5 years they're going to continue to outperform the market. And if they've been selling performance, the moment they don't have performance to sell anymore, that can get pretty ugly pretty quickly. We've lived that dream with a portfolio company. It's not fun. If they are selling solutions, which is also the direction I think a lot of firms are trying to move in the direction of, it's less about the product and today's performance, but more about how can you sell solutions that are designed to meet longer-term, objectives, and maybe not necessarily being benchmarked against an index, quarter to quarter, year to year, but maybe more measured about your ability to deliver solutions or stated goals and objectives over a longer period of time. That type of business, I think we can, maybe get a little bit more comfortable with.
The audience, questions? We'll start calling on people.
Question over here. Do you see any growth in ESG, sustainable investing? Do you see these niches coming up, minority-owned firms? Do you see that, or is that going to remain just a niche?
I'll go first. I expect you'll continue to see very significant growth. I think it was Patrick who made a comment that in general Europe seems to lag the US marketplace by 5 to 7 years. I think when it comes to ESG, that's the one area you'd really flip that on its head. And by the way, 5 to 7 years might even be aggressive. It might almost be more like 7 to 10 years. I think in terms of the US lagging Europe. We see it a lot from European LPs or prospective LPs when we go to fundraise. They're very focused on ESG issues of diversity, and So I think it's going to continue to grow in the U.S. It's an industry that's also been evolving. I think the roots of the industry, it was it started sort of on an exclusionary basis, which is, okay, we don't like the sin stocks, tobacco or gambling, so it'll be an index, but just take those out. And of course, the big concern was, are you sacrificing return? And so I think a lot of the early investors in this space were somewhat mission-driven and maybe less returns-driven. But I think it's been proven over time that you can have successful, you can invest in ESG and socially responsible type strategies, and actually not have to sacrifice returns. So I would expect to see continued growth in that area. And it's an area that we've spent some time looking into, both in terms of the actual managers as well as who are the data and analytics providers to those businesses.
Yeah, I would agree. From my perspective, Eaton Vance recently bought a firm called Calvert, which is an ESG platform, and the organic growth has been really good there. Federated just bought Hermes in the UK, which has a platform that does ESG advisory that's growing really fast. I guess the only pushback I would get to the growth side of it is that you're probably just disintermediating assets that already exist.
One more thing to that, we see also the segmentation of it. So institutions right now that RFPs for bigger mandates are all looking at this, right? Not just exclusionary, but look at the wealth platforms. So take Merrill. Merrill is a multi-trillion-dollar platform. If you look at what's really in ESG, SRI, however you want to term it, impact, there's less than $15 billion on the platform out of multi-trillions. So it's very, very early on that side. And then you've got ruling by the regulators in regard to including the 401k platforms, which is where a lot of the mutual fund growth is coming from. And the whole, are you giving up returns for it? And the potential for litigation are not allowing many plan sponsors and consultants to put ESG, SRI impact-related funds onto those platforms. So it's still got to evolve. It's in the early days.
Thank you, Peter. Erik?
I say from a governance point of view, two quick little observations or stories. I had the opportunity to go down. Wharton has a 2-day board school. If you're on a board of mutual fund companies, it was a neat little experience. So I walked through being prepared for a hostile or an activist. Starboard out there has got a $7 billion fund. They kick out some pretty big CEOs. I do M&A. I don't get involved in hostile stuff. It was a nice perspective. But immediately afterwards, we had a lunch, and the head of governance from Vanguard came in. And obviously, I do asset management deals. I've seen all the indexing trends, and look up ownership of all sorts of different companies, either for personal use or professional use. State Street, Vanguard, and BlackRock are huge investors, and they are not going away ever. And when the head of Vanguard corporate governance sits there and says, by the way, when you come running in here with your management team, your board of directors, and it's the first time I've ever met you, on why your plan is a lot better than the activists, that tells me something. And then we walk through the math. The way the activists win, which I hadn't really thought about it, they don't actually have to get to 51%. Once they get a block, they only need to go convince about 5 of you, big owners, that their plan is better. 5. And they're very quickly to 35%. That means on the remaining 65, they only have to win a small fraction of the remaining 65 to kick out an entire group of board of directors. So you flip around to Larry Fink, and probably part for business reasons, maybe because he's human, maybe for ego reasons, he now puts out this little annual letter that he sends to all 500 CEOs, and now I think he sent them to all 500 board of directors of the S&P 500, because guess what? Larry Fink and all of his shareholders and investors own those stocks forever. And I think that's really important from a governance standpoint, whether you're a trustee, whether you're a fiduciary, whether you're running one of these money managers, whether you're thinking of launching an ESG, style product or just being aware or mindful of it. I think it's going to impact the industry in like more ways than we necessarily anticipate. I think it's going to be a big growth area.
Paul?
So Patrick, does the public company cohort of asset management, does that shrink? Does that expand? What's the landscape look like in 5 years? The same?
Yeah, I suspect it looks similar. I mean, I agree with Erik that there needs to be consolidation, but I think all of them are having a really hard time figuring out how to consolidate without just putting two kind of struggling businesses together, which is why I don't think you've seen more. And Janus Henderson's kind of the big example we have, and it's been great from a cost kind of cutting perspective, but from a kind of business standpoint, it hasn't worked that well. And you got this really nice positive reaction in the market when they announced the deal and gave it all back up until it actually closed, and then they've gotten the expense synergies coming through. But now, through my due diligence, the view from their own clients is they just don't like it. It hasn't really created anything better. And I think, the remaining publics are having a hard time figuring out how to get bigger without just getting bigger, but also doubling their outflow problem. So my view is, and I'm in the minority, that you won't see a lot of big deals in the public side anymore. You'll see more the public guys trying to buy smaller niche players that add something new and different to their business mix, and it'll probably be something alternative.
So I'm obviously not the public guy up here, but agree with pretty much everything you said, especially you look at the Janus Henderson merger and the proverbial sort of two drunks helping each other home. And I think that, and you touched on part of the issue, I think, is it got at maybe the margin side, and they can get an expense takeout, but it doesn't seem to do anything to address the more fundamental issue of just the challenges that the industry's facing. I think and I do think up until this point, there has been a lot less consolidation and merger activity in the industry at large, certainly relative to what people might have thought. And I think you had when you had that Janus Henderson deal, or even the Standard Life Aberdeen deal, I think people thought, is this going to is this the starting gun for massive consolidation? And it really hasn't materialized. The one thing I'd add to it, though, is I think part of that is because of the markets. And in the markets like we've had, everyone's a genius, and there's no pressure on these businesses to do anything, because they don't have to be any better than they were the year before, and if the market just keeps going up, they're making more money. And so I do think what could fundamentally change that is if and when we get some type of recession, some type of market correction, I think you would start to see some of these managers that would struggle a bit more, and I think you could see that acting as a bit of a catalyst for some M&A and consolidation.
Yeah, I would just add that if you look at mutual fund data, which is the most public, a lot of firms have had AUM growth. You look at net assets flows, that's a much narrower list, and there's a big fall off from the top five, BlackRock, T. Rowe, Dimensional, to everyone else. I mean, it's like they fall off a cliff in terms of net flows. And the number of big firms with negative net flows and persistent year after year net flows is shocking.
Well, it's almost the entire industry, excluding those top five. I mean, they're the corner pocket on a tilted pool table.
To follow up on that point, yeah, I kind of agree with you. I think a lot of the buyers of those assets will probably be non-U.S. You won't see a lot of U.S. public asset managers, at least, buying those distressed asset managers when the market goes down.
Yes?
I think there could be an argument made that this concentration in the top five players should designate new cities, or how do you think the government should be viewing that huge concentration?
You want me to start with that?
Sure.
I haven't heard that one in a while. I guess post-Trump people aren't really. Oh, sure. The question was, with the concentration of assets increasingly with the largest firms, does that put them on the radar as SIFIs? Even when we had a Democratic administration, I think they decided that that wasn't the case because of the view that the strategies are chosen by the client, which are generally institutions.
Are CEOs, CEOs chosen by clients It's already been one takedown.
Yeah, but they were being originated by depository institutions, which were backed by the government. I see the argument, but I just don't see how they're as systemically important as the banks were in terms of their interconnectedness to the broader economy. Because indeed, and that's not to say I don't think there would be a pretty significant negative feedback loop from a real correction with a lot of outflows from these passive funds. I think it would almost certainly make the downturn worse than it would have been had there not been so much money in passive funds. But I don't know that that's enough to put them on the radar as SIFIs, particularly in a Republican administration. Yeah.
Are you seeing as much leverage in the asset management industry as you saw?
No. I mean, where you might be seeing it, and we don't have much color on it, and it's something I'm very worried about because I cover the large alternative asset managers as well that are public, the KKRs and Blackstones, is a lot of the riskier lending that banks used to do before the crisis is being done by alternative asset managers and kind of mezzanine funds, direct lending funds. I think that's where a lot of the more risky leverage is now, and we really don't have a lot of visibility on how these things are structured and what the credits are. But as far as the large traditional asset managers, no, I don't see anything similar.
I mean, I'd comment in the private equities world, there's a lot of leverage. And, even asset managers that not that long ago, it seems like the conventional wisdom was you maybe didn't want more than 4 turns of leverage just because of the correlation in the marketplace. I think a lot of the deals that I've seen get done are probably having 6 turns of leverage, maybe even a little bit more. I think an important consideration, though, is that most of this is covenant light or lacking any real covenants. And so I think the key to that is, again, when you get a downturn or a correction, at least the bank isn't going to have the ability to show up and take the keys from you, and you as the owner will at least still have the advantage of time to work out of this or wait for a market, for the market to rebound.
Follow-on question might be, if the Fed really starts to get serious, taking the money away, is that going to affect that thinking?
Well, I mean, from a rate perspective, I gotta say, I think it's a supply-demand issue at the moment. I mean, just and as Patrick said, sort of these private credit funds, the amount of, go look at like an Ares or a Antares or a Gall. The amount of capital that has just gone into these credit funds is extraordinary, and they've got to find ways to put it to work. And I'd also comment that, even with rising rates, within bounds, when you actually sensitize, of course, private equity, we all have our models, we build our models, and as I always like to remind some of the more junior colleagues, the only thing you know for certain is your model's wrong. But at least they're helpful to run sensitivities, and what you find is it's actually the returns, our equity returns are a lot less sensitive to the interest you're paying, to the rate on the debt, much more sensitive to the quantum of debt available. So I'm, as long as you've got money flowing into these credit funds and a pretty robust M&A environment, I think you're going to continue to see, these levels of leverage. And let me be clear, I'm not saying that's necessarily a good thing. It's something we struggle with a lot. But I'm not sure I necessarily see it going away all that quickly either.
Maybe tying your question with the SIFI question, credit is the lifeblood of private equity, and leverage ratios have absolutely been going up. We did the equity comp plan for Russell, and I think all the deal stuff on that is public, or it's quasi-public, given they issued. there's a lot of debt. Now, the company, since they bought it, has performed very, very well. And credit is consumed by the private buyers and the repackaging of CLOs, because as we've been told by some big insurance companies, there's not enough AAA and AA corporate paper issued in the world to satisfy the insurance company's needs. So the purpose of CLOs is repackaging lower credit quality and getting family offices and others to take the equity-based risks. So choke off the credit and the leverage ratios will come down. With regard to SIFI, look, they could regulate anything, okay, if they so choose, whether it's called SIFI or not. On the insurance company, and I know there's someone here from one of the insurance regulatory governing bodies, what do the insurance regulators worry about? Credit quality, but not so much about liquidity. On the banking regulatory, they worry about credit quality as well as liquidity. It's called a run on the bank for a reason, right? It's not a run on the insurance company. And so Roge and Ronoff wrote that piece on financial crises that in a dot-com crisis, why the economy recovers so quickly versus a credit crisis, dot-com was like, wow, I'm rich. Well, I'm not so rich, right? Our problem was, wow, we're rich. And, whatever, they look 200 years of data on credit crisis. It's like, wow, I'm rich. Oh, now I'm not so rich. And, oh, crap, I got this huge hangover of debt I have to pay off. I think with regard to the top 5, you have a asset liability match, right? I can put money in the S&P 500 with BlackRock, and I can get it out tomorrow. So unless the markets broadly fail for some reason, the New York Stock Exchange shuts down, they're largely running matched books from an asset liability duration match. They may choose to regulate them for another reason, just because the numbers are gigantic and they control so much. But I would bet that regulatory framework is going to look different than whatever SIFI is, because they just play a different role in the market. But yeah, that kind of concentration risk, if there's ever an oopsie, and you can't really regulate human behavior and emotions on how people invest and take risk and loss aversion and all that other, social economic issues that come out. So could they? Yeah, absolutely. Is it going to look different than SIFI? Almost certainly, I would bet.
Well, the SEC is already sort of tiptoeing into that with requiring mutual funds to have liquidity schemes and maybe even bucket the securities and their funds into liquidity buckets. Because that's a little baby step in that direction to think about liquidity to meet shareholders' demand in a crisis.
Yeah, Patrick, I just had a quick question. You mentioned that you said that the press was making some deal about active this year, active management, and that's not the case. So that's interesting. How do you give us a little bit more on that? How do you break that down? Because most of the people in this room do a lot of active investing. If that statement is false, we should understand that.
Yeah, I mean, there's so many ways to cut the data, so I don't know where they're getting the numbers. And even some of my competitors have put stuff out, I think, suggesting this. Without seeing what they do, it's hard for me to really know. But, I try to keep it fairly honest, and if you just run the numbers in like a Morningstar type framework, are you outperforming your benchmark? It's kind of consistently only 50% do. And if you look at the flow dynamics in the industry, that's not even good enough anymore. So even if 100% were outperforming the benchmark, I don't think it would really move the needle enough, because from what I can tell, the only firms that are taking in flow are kind of top quartile, top decile. So it's not even enough to outperform the benchmark. But why are they reporting it falsely? I don't know how they're cutting it. I'm sorry. Yeah, it just from my perspective, from my perch, the numbers that I run don't suggest that. Yeah.
So basically, kind of more or less the same pattern.
It feels like a very similar pattern to what we've seen, over the years. Yeah.
Brian Furtado is here from BlackRock, and BlackRock's been it seems if you counted up one firm name that's been mentioned over and over. I think you win today, Brian. Inquiring minds want to know, is Larry really serious about all of this public governance issues he's claiming, or is he really running for office?
Look, I do know what's going on in Larry's mind. He was here, when was he here, Steve? He was here.
Yeah, 3 years ago.
A year ago, so yeah. I mean, he is very serious about all the money, for sure. I mean, all the money that we control, and I think it was a really good point that was made about just the responsibility to investors, and I think, and he's going to be more active about that. I think he's been pretty vocal about that, and, working with boards and working, with investors. So I think, I think it's all, I think you guys all made really good points about what's going on, and the technology thing is a really big deal, though. I think that's the one thing that we see really reshaping everything, and that's where he's spending. It's not just talking about the governance issue. It's about the technology issue and just how do we reshape the business and the landscape. So I think there's going to be more and more investment in that, and I think we'll all be really surprised at just how the industry is going to change. It's really interesting panel.
I mean, I thought it was pretty interesting it was just the other day, I think there was an article about, it looks like, right, BlackRock's going to now try and take Aladdin and kind of apply it to the wealth management space as opposed to just institutional asset management. And I think that's really interesting. I think if you're a wealth manager in the marketplace, you probably need to be a little bit concerned about that. But
yeah, I mean, technology, Larry's in Silicon Valley right now. Tonight he's meeting with 25 CEOs. I'm not sure exactly what they're talking about tonight, but he's out there
but I mean,
virtually every week, and there's no conversation you have with him that doesn't talk about technology and how it's impacted the business.
Yeah. But I mean, especially because you've got the data, you've got the technology, and you've got the ability to deliver the solutions through with all of the sort of low-cost, iShares building blocks, which I think is really interesting.
If I may, it's this whole technology play. Look at BlackRock and building tech company. When you think about how many 3,000-4,000 programs you have. But to your point on Aladdin, not just institutionally, they're already in Morgan Stanley and UBS with Aladdin. They've got your personal Aladdin where you can go to the RIA marketplace. And if you think about it, how we look at it is they're at the center of where all portfolios are getting constructed. And that's where they want to go, because if they're there and they can wrap it around, your risk base of how you're allocating, you're going to capture more than your fair share as BlackRock, okay? And they get into other things. When you look at iRetire that they have, you look at Future Advisor that they have, you look at Capital that they have,
Yep.
and you go down the list of fintech investments that you're making, all complementing that. So it's very interesting that center, that nerve being at portfolio construction for the individual and the institution. It's a game changer.
And if you all have a look, iCapital, I think I'm sure you guys all know iCapital.
Yeah.
And Lawrence Calcano, who lives right here in town, and that's a fascinating business. Talk about reshaping distribution. I just had a sat with him recently. I looked at the platform. It's changing everything in terms of how you distribute alternatives. And you can do things through the iCapital platform that we just wouldn't have done years ago. And so it's pretty interesting.
We've got an investment in a direct competitor, so very familiar with it.
So I don't know, I guess for anyone, maybe starting with Patrick. So does the value propositions shift from security selection to asset allocation in portfolio?
I think it already has. Yeah, which is feeds into what we've all been talking about with BlackRock and what they're doing, and they're one of, if not the only public one at least, that's put all of these pieces together from a portfolio construction standpoint and then put it into a distribution platform. But what we have seen is those active managers that have gotten into, say, model portfolios or gotten into the solution side of the business generally have much better flows than those that haven't. So I think we're there. Yeah.
Eric or Rick?
If I may, you all spoke different ways on the alternative investment business. I completely agree with almost everything you said and the trends and where it's going. And can't get passive away, if you will, right? You're not going to disintermediate. But when you look at the credit, the equity, or infrastructure, and whatnot, the question I have is when you look at the publics, right? And all the capital that's flowing into those firms, when you just pick up the paper and read Blackstone just got another $9 billion for an infrastructure fund in, over Asia. It keeps going on. Love your investment thesis of would you invest as an LP in one of their partnerships, although you could argue on the deal side how it's a race and a chase for less opportunity, or buying the stock when many of these, whether you're in Carlyle or you're looking Blackstone, you're getting paid 6-7% distribution or dividend yield, and then hold it because you're then buying the GP as opposed to going and LP. So I love your investment thesis on playing either side of that.
If the public market would recognize the value of the firms, I think I would say that buying into the GP is more attractive, particularly because I think that the market still discounts the value of the management fee side of the business. I mean, it's probably the highest quality fee stream in financial services, right? You have locked up capital without fee pressure with 40% margins that's growing at 5 to 10% a year organically. I mean, what's that worth to you? I think it's worth a lot more than the market's willing to pay for. So I think theoretically, I would say buy the GPs. But
Why doesn't the market recognize it?
well, the structure hurts, right? And we're seeing a couple go down the road of conversion to a C corp, and we'll see how that goes. But it's also just the difficulty in modeling the performance fee side of the business. And the volatility that the performance fee side of the business is, right? We just don't have many public companies where 70-80% of the earnings in any given year are not modelable, and I think that's really why. And it's why I've been skeptical the C corp conversion will really be enough to move the needle, because it doesn't change the fact that 70% of your earnings are still not modelable. With that said, if I could, legally, I would have all of them in my PA.
I'd vote for the GP. I mean, if you go to the asset liability framework of the pension system, and families' endowments have the same darn issue, they're going to use Vanguard and BlackRock and other, they're going to push fees down as low as possible. They'll still use active boutiques, but you can't replicate alternatives, and there's no price negotiation, right? You're a price taker if you talk to Apollo or Blackstone or GTCR. The yields are very, very attractive, and so if you're a long-term holder, I think you need to be prepared for some of the volatility, because they're quirky businesses, and the balance sheets are a mess on a GAAP basis. I mean, you might as well throw those out a window. And they're hard to model, they're hard to predict. But you have the long-term trends that to solve the return target, people need more alternatives, and so there is likely a long-term trend, very, very favorable to these types of managers. And what is happening is size, scale, and brand matters. Absolutely, right? If the state of New Jersey has a big problem, which they do, they can't allocate to middle market managers. They drive into New York City and give Leon Black $2 billion and ask him to solve the problem. The biggest institutions need to move billions and billions and billions of dollars into alternatives, as they have been, and they're not going to go to some firm that's raising a $500 million fund. They're just not, right? There's safety in whether it's Providence Equity, which is private with their Benefit Street, or Apollo and Blackstone. And I mean, these things are gigantic supermarkets, right? Gigantic, where you can get your real estate, your credit, your mezz, holy Christmas. Like, I wouldn't have necessarily predicted that 20 years ago.
The fee revenue streams aren't going away anytime soon,
No.
right?
I mean,
And permanent capital vehicles make it even more interesting.
so what are the risks to that thesis? Every state pension plan cuts their benefits, and they win the litigation in one day. state legislatures raise all of our taxes by another 20% to pay off the pension plans, and then they immunize. Like, none of that stuff's going to happen. There's a long-term underfunding problem. You know, funding status now with rates backing up probably 84%. Maybe with strong markets and rates backing up, it goes to higher 80s, but the problem's not going away.
The only thing that comes up in my world that people are a little worried about, but to the point on the ability to replicate their strategies, is that you are seeing, hints or chatter about pension funds trying to do it themselves, and sovereigns certainly want to do it themselves because the fees are so high. I just don't see how they do it without partnering with the large public ones, given the degree of intellectual capital they have built and the relationships they've built in terms of deal sourcing. The deal sourcing that the large conglomerates have is just untouched. It's almost oligopolistic now, which is something that is, these firms now have a very protected business given their size and scale. Yeah.
So we're at the end of our time. We're actually a little over. We could clearly go on for a couple more hours, I think, but we all have to get back to our workstations. Thank you all for coming, and thank you for the panel, which is fantastic. Steve?
Thanks, Michael. Okay, so a couple of words before we go. Connie reminds me, if you would fill out your comment cards, let the speakers know how they've done. And Connie, thank you for turning the air conditioning up. Appreciate that. I also want to apologize for the artwork in the gallery today. It's a little bit dark, a bit crazy.
It goes with the theme.
I was going to say, I thought it was reflective of the mood.
So much. Yeah, I know. It's wow. Saran.
This is high school works. There were 600 submitted, and these are 45 from about 30-some high schools all over Connecticut and New York. So that's why you're seeing this. It's called Live 3.
Angst.
I think that was a picture of Patrick up there. That big one.
Somebody's got to talk to these kids. I agree. Okay, so what's up next? July, emerging markets. Phil Zecker, when he gets back from Michigan, is going to surprise us with an interesting panel on emerging markets. Some of you may ask, how did you come up with this title? I'm working for Michael Bloomberg. It's 1989. Bloomberg says, McMenamin, go downtown. Lee Cooperman just left Goldman Sachs. He's starting a hedge fund. They're all scumbags. So I go downtown, and I'm sitting in the lobby of Cooperman's new fund. Old friend Lee Margolis was there from Goldman. I said, Lee, why is Leon starting a hedge fund? He said, Steve, it's the most profitable business in the world. And the rest is history. So that's the title. In September, I think we're going to take August off unless Michael comes up with another good panel. Take August, thank God. And so September, we got Chairman Griswold. He's putting together a very good panel on asset allocation. And we're going to hear why the endowment model is dead. No, sorry. That's an inside joke. So it's just tweaked. In October, Lucy Stitzer is coming back. And she's putting together a panel on agriculture technology. And if you don't know Lucy, she is the chairman of Cargill. So we'll hear about that in October. And Brian Furtado has promised something for November and December, but he's not telling us what it is. So, yeah, exactly.
Larry's coming back.
Larry is coming. Let's hope. That was good. That was a good session. So with that, I just want to say, Patrick, Erik, Rich, very good job. Thank you, gentlemen.
Thank you.
Thank you.